If you select a 30-year mortgage instead of 15, you could end up paying $183,000 more over the 30-year period. But is that the full story? To find out more, let's look at pros and cons of each option so you can decide what works best for you. Before we do a comparison, let's look at an example so we have a better understanding of what the monthly payments could look like for 15 or 30-year option and what the interest rates are. Let's assume you're buying a house that is worth $500,000 with a down payment of 20%. So that means you are putting down $100,000 and your loan balance will be $400,000. In terms of the interest rate for the 15-year option, it will be around 3.25% based on the current rates. And for the 30-year option, the interest rate will be around 4%. Based on these numbers, the monthly payment come out to be as follows. For the 15-year option, you will have to pay $2,959 per month. And for the 30-year option, you will have to pay $1,910. Note that the property taxes and other fees are not included in this as they will change based on your location. Now let's look at the pros and cons of each option, and we will focus on 30-year mortgage first since that is the most commonly used option. About 85% of mortgages are based on the 30-year period. It is a fixed mortgage and the loan is paid over 30 years. By fixed mortgage, it means that the interest rate does not change for 30 years. Whatever you agree upon at the beginning of the loan period is what you will have to pay. Of course, you do have the option of refinancing it down the road if you do come across lower interest rates, but if you do not refinance, then you will have to pay the interest rate that is agreed upon at the beginning. The pros of 30-year mortgage are as follows. Number one is low monthly payment. Since the loan is divided over 30 years, the amount of money that you pay on a monthly basis is lower compared to, let's say, 15 or 20-year mortgage. And that is one of the main reasons many people go for this option. Number two is bigger tax deductions. If you are among 30% of Americans that itemize their deductions, then you will have a bigger tax deduction with a 30-year mortgage because you will pay more in interest. If you do standard deduction, then this benefit is not applicable to you. Number three is more money to invest or pay down other debt. So if you go for the 30-year option, that means your monthly payments will be lower. So you will have more money remaining at the end of the month that can be invested, or you can use it to pay down other debt. If you are careful with your investments, you can actually make a lot more money from your investments compared to what you will have to pay in interest payments for the 30-year option compared to 15-year option. Now let's look at some of the cons of 30-year mortgage, and the number one is high interest rate. Interest rates for 30-year mortgages are always higher than 15 years because the bank is taking a bigger risk. There is a higher chance that something could happen to you in 30 years compared to 15 years. The interest rates for 15-year mortgages are sometimes 1% lower than the 30-year mortgage. So therefore, even if you take a 30-year mortgage and pay it off in 15 years, you will still end up paying more money in interest because the interest rate is higher. Number two is slower equity buildup. So for a 30-year mortgage, since you pay less in monthly payments, on top of that, you have a high interest rates. Therefore, most of your payments, at least in the beginning, are going towards paying down that interest balance, and you will have a lot less equity compared to a 15-year option if you decide to sell the house in a few years. Now let's look at the 15-year mortgage, and that is also a fixed mortgage. That means the interest rate does not change unless you refinance it. In terms of benefits of 15-year mortgage, number one is low interest rate. Since the bank is taking lesser risk, it is only for 15 years instead of 30 years, they will give you a better interest rate. Number two is faster equity buildup. So for a 15-year mortgage, more of your payments are going towards paying down that principal balance. Therefore, you have a faster equity buildup. And if you decide to sell the house in a few years, you will be able to get a lot more money. Number three is short loan duration. So of course, for a 15-year mortgage, after 15 years, your house will be paid off, and now you will have a lot more money that can be used for investment purposes. On top of that, let's say if something unexpected happens, you lose your job or something else, at least you won't have to worry about mortgage payments. Number four is guaranteed savings. When many people go for 30-year mortgage, they assume that they can take the remaining money and invest it into the market and get a better return. The problem is they're not factoring in the risk. What if you invest the money in the stock market and eventually when you're about to retire, let's say 30 years from now, there is an unexpected market crash and you lose all of your investments? With the 15-year mortgage, at least you are guaranteed to save the money on interest. Now let's look at some of the cons of 15-year mortgage, and number one is high monthly payment. Since the loan will be paid off in 15 years, of course the amount that you'll have to pay on a monthly basis is higher. And if everything goes well, then it's okay. But the problem is, let's say if you do lose your job, now you'll have to worry about coming up with a bigger payment on a monthly basis. Number two is less cash for investment. So if you're taking most of your monthly payment and it's going towards a 15-year mortgage, then of course you will have less money that can be invested in the market, which could double or triple depending on the market conditions. All right, so with all the pros and cons of 15 and 30-year mortgage, which one is best for you? Let's look at a few things that can help you decide which one is a better option. Number one is how much you're willing to pay per month. Many people, when they buy a house, they always look at the monthly payment. So if they go for the 30-year mortgage, they will just end up buying a bigger house, and that is a problem. You have to decide how much you're willing to allocate towards housing expenses and how much of the money you want to invest in the market. Number two is how much is your down payment. So a bigger down payment can actually reduce the monthly payment that you will have to do on a 15-year mortgage, and it can make it much more affordable. Number three is emergency savings. If you do not have any money saved for emergency purposes, then you should go for the 30-year mortgage because that will give you some extra money that can be used for saving. Number four is your retirement savings. If you are maxing out your 401k and Roth IRA, then you should go for the 15-year option because you clearly have enough money to cover for that. But if you are not putting down anything for retirement purposes, then you should definitely go for the 30-year mortgage. Number five is your investment goals and commitments. If you are committed on investing the payment difference between 15-year mortgage and 30-year mortgage, then it is fine, you can go for the 30-year mortgage. But if you are worried that the extra payment will go towards paying down for a new car, then you should definitely go for the 15-year mortgage because there is a high chance you will end up spending that money somewhere else. That is all from this video. I hope you got some value out of it, and hopefully based on the information that I have provided, you will be able to select the option that works best for you.